Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about this subject. The capital gains inclusion rate is going up in Canada. Now, well, we think it's going to be going up. We'll find out in a couple months. But it looks like it's a locked-in deal. Now, we've been expecting this for a couple years now. We thought it would go up as high as 75%. It's not quite there. But today what I'm going to be sharing with you is not the whole budget of 2024, but just talking about the capital gains inclusion rate. What does it mean for you as an individual, and what does it mean for you as a business owner or corporation? And I'm going to provide a couple solutions here as to how you can combat this increased taxation for you. Okay, so without further ado, let's get into why you're here, and keep on putting those comments below. I love reading your comments. It lets me know that the material that I'm presenting for you is resonating with you and you really love it, so please continue to comment, and thanks for doing so. Okay, so let's talk about this higher new rate. It applies on all gains above $250,000 for individuals, and bad news for companies, it's on all gains realized in corporations and trusts as of June 25th, 2024. Now, the Ontario tax rates, let's just talk about Ontario for now. These are changing, right? So for individuals and corporations, you're going from the highest tax rate of 26.77% up to now 35.69%. And for corporations, really bad news. This is really bad news for corporations. It's hitting you the hardest as compared to individuals. So it's going from 28.97% all the way up to 38.62%. So really bad news, but I got a really good solution for you. Now, this is not the first time that we've seen these kind of changes to the capital gains inclusion rate. Look at this. In 1998 to 85 to 88, it was 50%. 88 to 89 was about what it's going up to now, 66.7%. 1990 to 1999 was 75%, and here we are from 2001 to 2024, it's at 50%. So this is not new. We've seen these throughout the history, and we're sliding back up that scale again. Okay, so what does this mean for you? So really what this means, people ask me, I had one comment from a client asking me, how does this affect our life insurance, cash values in life insurance? It doesn't affect that at all. What it's really going to affect are things like real estate. So if you've got rental properties, a cottage, place in Florida, all those pieces of property are either in a corporation or you own them personally, and they are appreciated in value over your lifetime, and there's going to be a capital gain. And so really trying to pass this on to the next generation is going to be a bit of a challenge. Some of you want that cottage, for instance, to be passed on to your kids, and you may have picked that cottage up from your parents, and so you're probably aware of how that works in terms of the capital gain. So let's look at an example. Okay, so a cottage that was purchased, let's say for $100,000, sells for $900,000. Especially during COVID, the prices went through the roof, and there's a capital gain of $800,000. So what you've been used to hearing is that the capital gain is taxed at a 50% inclusion rate. So that would mean $400,000 is exposed for taxation. Now what's going to be happening is after June 25th, only the first $250,000 is going to be taxed at 50%, and then anything above that $250,000 would be at the 67 or 66.7%. So on a cottage that you purchased for $100,000, let's just keep this simple. I'm not going to talk about what you did to fix it. So the ACB on this property is $100,000. And it sells for $900,000, you're going to pay $491,850 in a capital gain. So that is a big jump. It's nearly $100,000 bill for you. So the question for you is, what are you going to do about that? But before I get into that, let's talk about you as a business owner. What does it mean for you? And I just said a moment ago, this is the worst thing for a business owner to have happen. You know, Canada is not friendly for companies to keep your money in your corporation. They want you to use that money to grow your company and expand, hire more people. They don't like you investing it into the stock market or investing it anywhere else. They really are taxing you heavily for doing so. So it's going to cost you more money to take money out of your company. So let's look at that. Corporations do not get the $250,000 limit that individuals get. So you are going to pay tax on the new higher rate on the very first dollar of capital gains. So you're going from 28.97% to 38.62%. Suffering. It was already a bad situation with the passive income tax, and now you want to pull money out, and this is just going to be a disaster. Many of you business owners are keeping your money in your corporation. You're not touching that corporate asset. I see it all the time when I talk to business owners and do reviews. You don't want to take any money out of that because you're going to have a disposition. I know it's a headache for you, but now this is going to be even worse for you if you just leave it there. So we got to have a solution for that. Let's get into what that might be. Now, Jamie Golenbeck is an industry expert. He's the managing director of tax and estate planning with CIBC Wealth, Private Wealth Management. You'll see him all over the news. He's a frequent guest on BNN and all the financial talk, and they go to him for all these wonderful new programs, and he gives us some really good insight. And he said right away, he said, about this new capital gains inclusion rate, he said, these investors will need to ask, is there some kind of way to get those investments out of the corporation without paying a great whack of tax? And he's been quoted as saying one of the solutions is using whole life insurance or participating life insurance to shelter those assets. It's an investment savings and it's tax sheltering. He also said that permanent life insurance as a replacement for fixed income and the non-registered investing of permanent capital. So what does he mean by that? What are we talking about? So let's talk about participating life insurance. Remember, he said it is a replacement for fixed income. So you see that pie chart that's in front of you. We're just talking about not all of your money. We're talking about the fixed income part of your portfolio. I'm going to get into why we're only talking about that. So whether you're a corporation or whether you're an individual, we're talking about the money that is being taxed heavily because it's not sheltered from anything. And this is what whole life or participating life is going to do for you. So when we say all of your investments, you've got your real estate investments, you've got equities, meaning stocks, and then you've got fixed income. That fixed income is what we're talking about. It's really the low return, it's high tax rate. It's not doing you any good in a non-registered portfolio. It's at the highest rate and it's low returns. And if you're in a corporation, it's passive income tax. It's really bad news. So what can you do? Let's talk about that. We're going to talk about how participating life insurance is an alternative for you to be able to fix this problem for you, especially if you're in a non-registered portfolio. You got a lot of money there. Maybe you downsized your house and you got $1 or $2 million in a non-registered account and you're paying tax on money that you're hardly even touching. So here would be a great way for you to shelter some of that money in participating life insurance. So you could call it whole life insurance. Same thing. If you're a corporation, you've got this money that's in a corporation, you're investing in different kind of mutual funds, ETFs, whatever is your flavor, but essentially you're paying tax on that and it's just suffering. It's really a disincentive for you to keep that money. So instead what you're going to do is you're going to deposit money into a corporately owned participating life insurance. If you're not a company and you're an individual, you're going to deposit that money into an individual whole life or participating life insurance. If you're a couple, you just do it a joint. If you're a single person, you do a single life insurance. It's really not complicated, pretty easy stuff. Now that money that is inside of a life insurance, you're probably not aware of this, that when you deposit money to a life insurance, a cash value life insurance policy, you don't pay tax on the growth of that. You don't have to report it as income. You actually, so you're saying, what do you mean tax? What do you mean income? Well, let me explain that. When you have a whole life insurance policy or participating life insurance policy, the insurance company deposits a dividend into your life insurance in addition to your deposit. And that money that they're depositing is a dividend. But ordinarily, if you're familiar with a non-registered investment account, you would have to pay dividend income. But in this case, the tax laws in Canada is when life insurance has money being deposited to it, cash value life insurance, whether it's your money or a dividend that's going in, the growth of that money is tax-free. You don't pay any tax on it. So that dividend that comes in, no income to you. So what's great about that, as an individual, if you're worried about your non-registered account interfering with their old age security and getting a clawback, well, you could start to push money from your whole life or from your non-registered account into the whole life, and thereby there'd be less money in the non-registered account that would get in the way of your clawback from your old age security, and you could just use the life insurance as storage of capital. Now, the great thing about the storage of capital is it has a death benefit, so you get this huge death benefit as well. But it's an awesome way for you to fix that problem with your clawback and old age security, to shelter your money from taxation. And if you're a corporation, you can get some of that money out of the corporation, not out of the corporation, but out of the corporation investment account into a corporate owned life insurance policy. It's not out of the corporation, still an asset of the company, except all you've done is you moved it from a taxable situation to a non-taxable situation. So this is awesome for everybody. So how does this work? Well, about that dividend. The dividend, you can see at the top, it says dividend scale interest rate, 10-year average return about 6.44%. Compare that to the S&P TSX, that's the Toronto stock market, 7.74% annualized return. And you can see here over the 10-year period. But what is not jumping out, I hope it is, but it probably isn't. The 7.74 is a gross return. The 6.44%, remember, you don't pay any income tax on that return. So that's just going into your policy without any income tax. On the S&P TSX, you're going to have to subtract out your taxation for that. So it's really a much better alternative for you using the whole life or the participating life insurance. Okay, so you say, okay, David, that all sounds pretty cool, but I'd like to be able to use that money at some point in the future. So let's look at how you use that money. So on the left there, you are either a business owner or you're an individual, okay, or a couple, and you're depositing money to your whole life insurance. You're doing that over time. That money is growing and it's compounding. You're not paying any income tax. You have access to that money anytime you like. But what you do after a certain period of time, you say, you know what, there's a lot of cash in there. I want to have access to that cash for whatever reason. And you say, you know what, I'd like to use it. Now, the best way to use this situation is to do a line of credit. So you approach a bank and you say to the bank, look at all this cash in here. It's secure. The cash value doesn't go down. It's always going up with the dividend. It's a really secure investment. And if I pass away, the death benefit's going to pay off the loan. So the risk to you is zero, basically, right? So they say, yeah, we'd be happy to take that loan. So they loan you. So now you are either a business owner or you're an individual. They loan that money to you. And when you receive a loan, what happens? Loans are not taxable, right? Loans are not income. And because they're not income, you don't pay any income tax. So you've been able to cut out Canada revenue by simply taking the money that was in a taxable situation, pushing it over to life insurance, let it grow and compound, and at a future date, you're just going to take a line of credit against that. And you say, well, wait a minute, I'm taking a loan against the cash value? Yeah, why? Because you want that cash value in the insurance to compound on itself, right? That 10-year average is 6.44%. You want that to compound. If you simply did a withdrawal of the cash, there'd be less money that would be compounding. So you take a line of credit, that's separate from the cash value. It is compounding. Yeah, you've got an interest rate on the line of credit. That's fine. Not to worry about that, because what's happening is you have a death benefit. And that death benefit is going to be paying off the loan when you pass away. So the combination here of you've got a cottage that has a capital gain on it, and you want to pass it over to the next generation. So you start depositing money into a whole life or participating life insurance policy today. Let that compound and grow. And if you want the access to the capital, you can. But certainly when you pass away, that death benefit is going to be there to eliminate some of the tax bill that you're going to have on that cottage. So it's a perfect solution. You're saving tax along the way. And at the very end, you can crush CRA's taxes as well with the life insurance. Now, if you are a business owner, even better, right? Because you get that money out of your company, and instead you're taking that individually. It's not going back to your if you want that loan to go to your company, you can, but you can actually receive that money personally. So think about that. You had this money in your corporation. You take it out, you got to pay that tax rate. But you put it to the insurance, take a loan against it, and take that loan personally to you, and you pay zero tax. It's awesome. So if you're interested to know how to get this accomplished, just send me an email. My information's all over the place, so you can reach me just about any way. But I hope that is a great solution to what is a bad situation for companies and for individuals having to pay more income tax on your capital gains. It was a pleasure seeing you in today's video. I hope to see you again in the next one. Thanks and be well.